Can you unmute yourself, Jose? You've been muted the whole time.
Sorry about that. Um, so let's get right into it here. Right. So, what is the importance of credit reports? I mean, uh, nowadays we assume that it's a given, but it wasn't always. Credit reports weren't always around. So our first credit reports were an attempt to standardize the credit reporting process, right? That's definitely way before computers back in 1841. Now, our first standardized credit reporting system, the FICO score, was introduced in 1989 with Equifax and TransUnion following soon after. So those are our three credit bureaus that are used. Those aren't the only ones, but those are the ones that are used for the credit scoring model. And very important to note for this exercise, especially and for adding value as a loan consultant, each of the credit bureaus has their own algorithm as to how they analyze the different components, right? Uh, Now, once credit scoring became uh, a thing, then that eliminated subjective review of borrowers' credit. That's one of my favorite parts of the whole process of having the standardized FICO scoring is that now you couldn't really borrowers could not be discriminated upon because of their credit because we had a system to review it. Now, real important for the lending industry, this automated crediting system sped up the loan approval process and increased origination output, right? Those are music to the ears of loan originators. Increased origination output means increased profit, increased earnings, because this allowed automation and scaling, all the things that we do now. DU, right, with automated underwriting, loan approval in seconds, all of that would not be possible if we would not have the credit scoring models as part of our originating system. So, what are the credit scores? Well, I've broken them down here into some ranges, and I've added a little bit of a commentary on how they can impact loan origination. Right, the highest tier you're probably looking at above a 750, with 850 being the maximum. And in this tier, definitely you're going to get the best pricing and the highest LTV possible, no loan level price adjustments kind of stuff. Now, in some cases, now it does vary from rate sheet to rate sheet, but in some cases, like the examples I was doing this morning in the daily rates, there were pricing adjustments below a 760. You started seeing pricing adjustments. So you're looking at here 700 to 749 being the next tier, but be aware that many loan options change drastically below 700. Typically, that's where you start seeing the elimination of the highest LTV range. For example, DSCR loans, right? Below a 700, it's tough to get that 80% LTV option for the DSCR, for example. Then you have our fair range, 650 to 699. Uh, and what I like to state here is that please be aware that for many non-QM options, or at least for the favorable ones, 660 is the cutoff. That's where you start seeing some drastic drops in LTVs for bank statement loans, DSCRs also. Then we have the poor tier, which is 600 to 649. Even though some people are saying, 649 is not that bad. Yeah, you'll close some loans there, but that's just how it's set up. Because if it's conventional, for example, you're definitely going to have loan level price adjustments at those scores. Mortgage insurance is going to be more expensive for the conventional loans at those scores as well. Keep in mind the minimum FICO score per the matrix for conventional is 620, but it's really up to the automated underwriting. And definitely reduced options, non-QM and LTVs, reduced LTVs, even though we do have a 600 credit score, for example, We do have 80% LTV bank statement purchase, non-QM. So we do have that. And then below 600 credit score, that's going to be considered, bad. But there are still options. We have options all the way down to a 500 credit score for VA and FHA, and I think USDA down to 550. We have DSCR down to 575. If you're below a 580, automatic underwriting isn't going to give you an approval above a 90% LTV. So those are some of the considerations that you have to take into note when you are looking at credit scores and seeing if this rescore is going to be necessary. For example, if you're looking at the FHA borrower with a 610 or 615, unless you're not getting that automated underwriting approval, you're probably going to get it. But there may be other factors going on there that may benefit from a higher credit score. But most of the time, you're going to get that automated underwriting approval. However, if you're looking at that DSCR loan, and let's say you want to do that 80% cash out on a DSCR where you need a 720, because we do have that option, then if you're at a 719, it's not just 1 point. It's 5% LTV that you're looking to get more. So can you find that extra point in the credit score, in the middle score, to get to the 80% margin? So that's why it's so important to take these factors into consideration early in the process when you're structuring your loan and you still have time to make a move. So in order, and now one of the reasons why I was stating why this is one of my favorite trainings is because of the amount of value that you can add to the transaction when you know what you're doing, when you're looking at the credit score, credit report, when you're consulting the borrower. This is a lot of cases what's going to get you that deal, what's going to convince that borrower to work with you. You might not have pulled the credit yet, but you can certainly discuss their credit. Even though it hasn't been pulled, they know what it is. They have an idea on the balances, and you can ask these kind of questions to let them know how, depending, like if they tell you my score is a 630, then you're going to say, well, why is it a 630? What's going on with the accounts? Well, how's the payment history? How's the credit utilization? How, have you had these accounts for a while? What type of accounts do you have? Are they new? Have you opened up new accounts? Did you just get a car loan for $100,000 or something like I just had a borrower get? So these are the different things you can ask, definitely, to engage the borrower. So knowing stuff like what's on this image here, right? 35% of the credit score is going to depend on the payment history. And obviously, late payments will affect the payment history. That's a full 35%. 30% is based on credit utilization. Now, payment history, the only way you can correct that is if by somehow or another you get that late payment reversed. And we all know how hard that is. That's usually not a rapid rescore type of a scenario. That's disputing and go to war with them, and could take months. Rapid rescore, remember the word rapid, right? So we're analyzing credit for opportunities here for stuff that can be done in a short amount of time. So credit utilization is 30% of their score, right? So when you're talking with the borrower, you haven't even looked at the credit report, but you're asking them questions on their utilization, just be aware that being at, near, or above the credit limit will definitely adversely affect the borrower's credit score. Length of credit history, or how deep your credit is, right? So the older the account, the better it's going to be for this section of the FICO score analysis, length of credit history, and it's a full 15%. Now, types of credit in use, we're basically, as in, is it an installment account, which would be like a car loan and a mortgage. A mortgage is a long installment. Or is it revolving credit? Right. So the one thing how they're different there is that, for example, revolving credit, the utilization is reported. So when you bring that down, it helps your credit score. Installment accounts, the utilization is not reported, only whether it's open or closed, how long it's been open. So the longer it's been open and still open, it's good for an installment account. But the minute you pay off an installment account and close it, the credit score drops. So, because it's one less account with a nice history that's taken into consideration. So you can see how the types of credit in use will affect. And also, new or recent credit is another 10% factor. So, in other words, newly opened accounts usually will negatively affect your credit score, and you don't really want to do that unless it's part of the rapid rescore recommendations. So, very important now, before you embark on the mission of the rescoring of accounts and balances and all that, just let's review the credit report for a minute and let's see what's actually there, right? Because basic stuff like borrower information, address, stuff like that, if it's incorrect, can result in the credit score or different accounts being reported in error, like not reported, or get somebody else's information in their credit report because maybe it's matching a name because you didn't have the right address or something like that. All of these things are tied in together. So you really have to make sure that the address is correct, their name, legal name is correct, obviously date of birth, social security number, and everything is correct because that could cause errors. Review the report for red flags and alerts. There could be social security number mismatch, an address mismatch, an identity freeze. You could also have excessive credit inquiries, which could mean not by the borrower, or maybe, what motive may the borrower have if he's gone and pulled their credit 35 times in the last month. Could be something going on. So definitely want to identify, correct these errors, address any concerns with the borrower. You want to review the number of trade lines and length of time those trade lines have been open, not just the credit scores, because in some cases, trade lines is an issue. In some non-QM, like we have, like an automated underwriting now, be aware. First thing you're going to do is you're going to run it through automated underwriting, and if it approves it and it doesn't give you a condition to add more trade lines, you're approved. You don't have to worry about trade lines. But if it's a manual underwritten case, you're going to have to worry about trade lines, whether it's a FHA manually underwritten or a VA manually underwritten or non-QM, which is always manually underwritten. At that point, the guidelines will tell you if you need 3 trade lines or 2, or if you need 3 credit scores, and that's it. They vary. It's not, in which, it's going to be different from each one. Real important, when you're reviewing those credit reports, please look for disputed accounts. Make sure if they exist, that you're aware that they exist, because that is going to be a determining factor in how you can proceed with your loan. Because, for example, if the loan is a conventional loan and you had disputed accounts and you didn't know about it, or FHA loan, you didn't know about it, and all of a sudden you realize you have disputed accounts, your automated underwriting findings could be invalid. You'd have to read actually to see what it says. And best case scenario for a conventional will say, hey, we see you have disputed accounts. Automated underwriting was able to make a determination, including those disputed accounts. No further action needed. This is obviously if you have your approved eligible, no further action is needed. Or it could tell you automated underwriting was not able to make a determination because of the disputed accounts. You have to downgrade this to manual underwriting, which is not possible on a conventional loan. And on FHA, it's going to be about the amount of the accounts. If it's $1,000 or more in total, then you got to downgrade to manual underwriting. Less than 1,000, you're good for your AUS. So look for those disputed accounts, because then if you got to remove it, it has to be removed via a rapid rescore, right? AUS has to pick up that there's no disputed accounts. So that is a process there. So now that we have identified some of the basics on credit scores, credit reports, right? Accuracy, credit scores, what affects credit scores. You see it right there. Do not leave money on the table. Every credit report that we at the Mortgage Calculator pull includes the option to run credit simulations to see the potential for borrowers to increase their credit scores. Now, all credit reports, wherever you get them, have that option. It is just that there's going to be a cost, usually. Now, at the Mortgage Calculator, we include the cost of the credit simulation in the credit report, so there should be never a reason for a loan officer not to explore any credit simulation opportunities should you think there may be a need. If you're on the edge of the credit tiers, there may be a need, so watch out. Now, there are two credit simulation models. One is the Wayfinder, which is more of an automatic model. It's an algorithm that searches for the best path to the desired credit score goal. You put a score you want, you click go. So I want to go to 700. You click go, and it'll tell you like what it says right there. We found a way to reach 700 or higher, 90% likely, and that's the amount of money you need to pay down 2 accounts. Right? Fine. And then you have the what if simulator, where you can actually manually enter different balances. So if you got 5 accounts, they each say $3,000 in balance, right? And you're looking to say, okay, what happens if this balance is 2,000 or 1,000? And then you start playing with the balances, and every time you play with the balance, the credit score may change, hopefully lower, right? So, and I like to test the Wayfinder most of the time, because then I'll go to the what if and I like to see if I can beat it. And most of the time we can. The goal here is to increase the middle score, right? Now that may entail working with more than one bureau depending on what the current score is. And why do I say that's important? Well, in the example I have there, let's say the goal is 660. Then you have 3 credit scores: a 630 from Experian, a 650 from Equifax, and a 657 from TransUnion. So remember this, you're saying, okay, my Equifax is my middle score is a 650, so let's work on the Equifax, and you forget to work on the TransUnion. What happens when the Equifax comes back at a 660? Now the TransUnion is the middle score at 657, right? So in this case, if your goal was a 660 middle score, you would have to rescore both Equifax and TransUnion. So you'd have to do the simulation for both, and then see, hopefully you have some overlap in the accounts that are paid off, right? But the algorithm is totally different. And you'll see this when you run your credit score simulations. You run the same scenario on 2 different bureaus, and in some cases a 20, 30 point difference. So that's very important to note. So let's go over a little bit more in depth on the credit simulation fundamentals, right? So here we're saying don't leave any money on the table. If you think a simulation is needed, let's break it down, right? And here we're breaking down then what would be some of the things that you would be looking for in the simulation. What improvements could you do? Well, you've already made sure the borrower's information is correct, right? Address and all that kind of stuff. So the things that we can affect in the rescore, some more really aggressively and directly than others. The one that we can show the most improvement, and this is only to revolving accounts, not installment, because remember, the installment accounts do not report the credit utilization, or they don't review credit utilization in the algorithm, just revolving. So some of the things we can do is the borrower can pay down balances. The borrower can also, and this is one most people don't think of, ask the creditors to increase the credit limits. And another one some people forget, the borrower can ask to be removed from high balance authorized user accounts. Sometimes that's what's holding them back, a high balance or a derogatory authorized user account, you get yourself removed off that account, you've just removed all connection to that account because you're just an authorized user. You're not the owner, not really the responsible party, even though the credit score is allowed to be used. Now, payment history. Payment history is one of the areas where it's limited success that you're going to have in the rescore, because the only way to improve the payment history is by the removal of late payments or the removal of collection accounts as actually being a collection account. Not paying it, but like, hey, that's not a collection. I'm removing that as a collection status and putting that as just regular paid as agreed status, right? So that will improve your score, but paying off a collection will not improve your score. Now you just have a paid collection. Maybe you had to pay it off to meet the guideline requirements to close that program, but paying off a collection is not going to increase your credit score, as most people would think. Another area where people get zapped and don't realize it is inactive accounts. If you have inactive accounts, realize that those accounts do not have a recent payment history. So those inactive accounts will actually lower the credit score, even if the account has a zero balance, because there's no payment history that is being taken into consideration for those accounts. So make sure when you're looking at those credit reports, then you see those zero balance accounts that haven't been used in 6, 7, 8, 9 months. Tell the borrower to start using them, at least to put a little gas in the car, maybe get something in the store or whatever, and then pay it back. Obviously, you don't want them to raise the balances, but you want them to have payment activity. I've seen it where the borrower has improved their credit score 50, 60, 70 points in a 1 to 2 month period by just showing activity in previously inactive revolving accounts. Those are credit cards. Now, new credit accounts, believe it or not, even as an authorized user, may improve the credit score if the borrower has very limited credit. That's one of the solutions that's given when you have low or no credit. Open up an account. Now, that's just the opposite. If you have many accounts and you open up a new one, now you have a new account that you didn't really need, and now you may actually lower the score because it's a new account. So it's a double-edged sword. But if you have limited or no credit, you need it. That's the only way you're going to get to where you need to be. I touched on this before. Paying off an installment account may actually lower your credit score. Also, be aware that when you do remove accounts from a dispute status, you just got to affect the credit score. It may, it almost always does. Not always if it has a zero balance, but removing an account from dispute status may reduce the credit score because now the system is taking into consideration that account, the balance it may have, and the payment history. So when you do run your simulations and you unclick to remove a dispute from an account, you're going to see what's going to happen. It may kill it. So that's why sometimes then you shift around to your guidelines. Oh, wait, this one says I can keep the dispute. Now you may have to go down QM. Now you may have to go FHA. If it's only $800 and you couldn't get it on a conventional approval, it kept telling them, sorry, we can't give you the approval because of the disputed account. We can't gauge it. Then you go FHA, only $800 disputed account. Then you can use your FHA findings, your automated underwriting approval. Right. So be aware of what happens with disputed accounts and how to treat the loans from a structure point of view. Make sure also if using Wayfinder that you properly set up Wayfinder on the amount that it can spend on each account on any changes. Make sure it's a high amount so that it doesn't tell you if you only keep it at like $500. It may tell you do 15 rescore 15 accounts because you only let it spend $500. So make sure you configure your Wayfinder so that it can ask the borrower to spend as much as they need to on those accounts. And last here, on our last slide here, there's our happy borrower, right? Loan approved, lowest rate possible. And how did that happen? That's because you, their loan consultant, was on top of the game early on, suggested a couple of rescores, and your borrower got the best deal, got approved for the loan, got that home. Now, what is very important to consider for the rapid rescore is, now some of these are pretty obvious, right? Only rescore the bureaus that need to be increased, right? Don't worry about doing all 3 bureaus if you only need 1 or 2 bureaus. That's pretty obvious, but sometimes it does happen where people just rescore all 3 because that's what they thought they had to do. That's only if you're looking to change a payment, and automated underwriting has to pick up the new payment, right? And you want it to always pick up that only payment amount because it's a new balance, then that's a different story. The cost of and another reason you only want to rescore what you need to is because the cost of the rescore can be between $40 and $50 per trade line being rescored per bureau. So one credit card will cost $40 to $50 from Experian, but if you got to do 2 bureaus, that's $80 to $100 depending on if you get a rush per credit card, and if you do 3, $120 to $150 per account. And that's really important because, as you can see there, the borrower can never pay for the cost of the rapid rescore. I had an MLO come to a meeting one day. She was looking to rescore like 15 accounts, right? 15 accounts on 2 bureaus. And I'm like, oh, wow, that sounds great. Do you know you got to pay for this? Oh, man, the silence was deafening. She did not know she had to pay for it. So had to go back to the drawing board. Now for AUS approval, like I just mentioned, to pick up the changes for example, for disputed accounts and balances and all that kind of stuff, that can only be removed via a rapid rescore. The rapid rescore can take up to 5 days to complete, sometimes maybe even 7 days. A rush fee can be paid for an extra $10 or $15 per account. There is a no doc option, but beware. If you get the no doc option because your customer can't provide the necessary documentation showing the new balances or showing that the account was removed from dispute status, that has to be obtained from the creditor, right? Hopefully faxed. They really like to email. If you go for the no doc option and they reject it because they got to do additional investigation, now your rescore can take up to 30 days. Now you're really stuck. Now you'd have to probably say, oh, please, can I cancel and resubmit as with the documentation. Borrowers cannot order a rapid rescore. It can only be like a financial institution. Be very aware also that a new credit report will need to be ordered to obtain the new credit scores once the rescore is complete. It doesn't happen automatically. They don't tell you, hey, the rescore is complete, and then all of a sudden, by magic, you get the new credit score showing on your existing report. No, you get a new report, but usually when you get the rescore, when you order the rescore, they give you the option to order that new report, and it's at a much reduced fee. So that always helps, but you do need a new report. It's going to be a new inquiry too on the borrower's credit so that you get the document with the new report number and new credit scores. Now, last but not least, I'll cover for a successful rescore. Now, you don't want to go through all the rescore process and then be off by 1 point because a customer forgot that they had this one credit card that was an auto debit for a payment, right? For a payment of another account that was paid automatically by that credit card, not by a debit card. And they forgot, and all of a sudden a 50, 60, or I had it happen on an account that had a $250 limit, very low limit card. The customer used it only to pay that one payment. It was like a $60 a month payment. That $60 a month payment came in, increased the utilization on her credit card, and caused us to be 1 point off on a rapid rescore. Pretty sad, so you don't want that to happen. So make sure the borrower does not open any new accounts unless it's part of the rescore. Make sure the borrower does not increase the balance on any installment, nor especially revolving accounts. And make sure the borrower does not close any zero balance or any accounts being paid off, because believe it or not, that could also adversely affect their credit score. So gave you a lot of great pointers here on how to be the ultimate loan consultant and be able to assist your borrowers and not miss any opportunities for a credit simulation and rapid rescore type of a scenario. Even if it doesn't happen, bring it up, propose it, analyze it. They may not need it, but that's going to elevate you as a mortgage loan originator to the status of like loan consultant, right? And if they were considering other people, they're definitely going to want to use a person who's caring so much about the whole process that is going above and beyond the call of duty to suggest these types of situations to better the borrower's position in terms of interest rate, lower fees, and everything else associated with a better credit score.
All right. Thank you, Jose. I don't see any questions here. So I think we can go ahead and wrap it up. Definitely great things to go over here tonight. So remember, everybody, that we do this on Tuesdays, Wednesdays, and Thursdays at 7 p.m. Eastern Time, where we go through a new loan officer training topic. So we'll see you back here next week on Tuesday at 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage